Let's explore fixed income markets, while also touching on ways not to get fired. What's going on, Kathy? You don't seem like yourself.
I have been so stressed out investing in equities and crypto, I'm afraid I will lose my job if I underperform again. Why are you always so relaxed?
Because I have been focusing on fixed income investments such as bonds. Specifically, ETFs like TLT, LQD, and HYG.
Can you teach me about those?
Sure, the TLT is a high-quality ETF that tracks the investment results of an index composed of U.S. Treasury bonds with remaining maturities greater than 20 years. While LQD is an investment-grade corporate bond ETF that tracks the investment results of an index composed of U.S. dollar-denominated, investment-grade corporate bonds. And finally, HYG are high-yield corporate bond ETFs that track the investment results of an index composed of U.S. dollar-denominated, high-yield corporate bonds.
I think I'm understanding. Basically, TLT are treasury bonds, LQD are investment-grade corporate bonds, and HYG are junk bonds.
Never call them junk bonds. We only referred to them as high-yielding bonds so they sound more attractive.
Well, how can you forecast the movements in bond prices?
Well, that depends mostly on fiscal policy, monetary policy, and economic conditions. For example, when the Fed runs a contractionary policy, they will raise rates, which ultimately raises other interest rates in the market, such as treasury bonds. When these yields raise, the price of the bond declines because investors can purchase a bond with a higher yield.
Well, this all sounds so simple, but what happens when inflation is higher than the yield on the treasury bond?
To protect against inflation, we can purchase Treasury inflation-protected securities, or TIPS, which are a type of U.S. Treasury security whose principal value is indexed to the rate of inflation. When inflation rises, the TIPS principal value is adjusted up. So if you had bought a 5-year Treasury inflation-protected note yielding 1% instead of the same maturity nominal Treasury note yielding 2.5%, you would have had made a better decision if inflation turned out to be what?
Greater than 1.5. Because the T-note was yielding at 2.5 and I invested in a TIP note yielding 1%. So if inflation were greater than 1.5%, I would have made a better decision, receiving a higher yield.
That is exactly right. Because the break-even inflation rate is calculated as nominal bond yield minus Treasury inflation-protected note yield. Now, let's wrap this up by talking about risk, which, in the Treasury bond market, is estimated using duration. As depicted by the graph, the higher the duration number, the more sensitive your bond investment will be to changes in interest rates.
So, if I invested in a 10-year bond at 3.3% and interest rates began to rise, the value of my bond would depreciate.
Exactly. Now you understand the basics. And you can stay away from crypto and meme stocks.